In this video, I want to go over why I think Powell is bluffing. I think deep down, the Fed chair knows that there is a recession imminent and that they are basically going to cause it. There really isn't a way out, in my personal opinion. And in this video, if you watch it all the way through, I really think it'll be worth your time because I'm going to show the actual details on the chart on why I think raising the federal funds rate will cause a recession as it has in the past. Let's just get right into it, actually. Let's go right to the charts, and I will show you exactly what I'm looking at and why I think a recession is about to happen. And Powell kind of knows this, but isn't just outright saying it. Let's go over to the chart. So this chart is basically the federal funds rate. Let me move myself over there. The federal funds rate is what they're talking about when they are saying, hey, we're raising it 25 basis points. By the way, 25 basis points is 0.25%. It's a fancy way of saying 0.25%. So to put it into perspective, last time we had inflation like this, they had to raise rates. So this means when they say they're talking about 0.25% raise, which is what they just did, they had to raise it to 22% in 1980. That's what Paul Volcker did. And this is back, I think inflation was just over 13% back then. So to stop a 13% inflation, they raised it to 22%. And right now they're talking about raising it a measly 0.25%. It is like using a squirt gun to handle a fire, pretty much. So every time, though, the main thing I wanted to bring up is it is one of the tools of the Fed to say, hey, we're going to hike rates. We're going to hike rates, and that's going to stop inflation. That's what we do at the Fed. So here we see the one time they hiked rates. So they go from, and this is back, rates were still high, 4.88. This is in the early 70s. They raise it up to 11. They raise it up even higher to 13. Boom. This gray period is a recession. So they raised it up. Recession follows. Goes back down, right? This is after the recession, after all the turmoil happens. Then we go back up on where they raise the rates. Boom, recession again. It goes back down, raise the rates, bigger recession, back down again. So they had to raise the rates, but to raise the rates, it is the painful medicine that then causes a recession. So then we go further. This is the last time we had inflation like this was with the Paul Volcker era when he raised rates to that crazy high 22%. And one could argue, if you look at, and I'm going to show these actual shadow stats chart, shout out to them for putting together a chart. If they use the same basket that they used for the CPI back in the 80s, you would actually, I'll show you the chart after this one here, and you'll see what I'm talking about. But if you used the CPI that they used back then, it would show that inflation is around 16, 17% right now, not the 7, 8% or 7.9% that we're being told. So we go back down, and this is the years down here. So that was the early 80s. We're back down for a while, This is the federal funds rate is still, and when I say back down, it was still 7%, 6%. It was still pretty high. They raise it a little bit, and what's next? A recession follows. Then it goes back down again. Stays flat for a while. They raise it from 4 back up to 6, almost 7, and then boom, recession follows. It goes back down. Then you go, this is the interesting one here, is the last major recession was 2008. We're down in 2004, we're down at a 1% federal funds rate. They raise it up. This is just the most obvious telltale sign here because this is actually somewhat recent. They raise the rates from that measly 1%, and keep in mind, they're not even at 1% right now. They raise it up to just over 5%, 5.3%. And what happens next? It's more expensive to get a loan on the house. They raise the rates. The housing bubble pops, and there is a major, major long recession to follow. You raise the rates, recession follows. Then we go flat for a while. And now we've just been basically, this is back when they kept it at 0 for as long as they did. Ironically, it's still pretty much at 0. They've raised it 25 basis points, so that means it's up to 0.25% and change. So still pretty much 0, but slightly up 0.25%. But you see that it stayed flat for quite some time after the 2008 recession. They just started to raise rates again, and then all the craziness that has happened over the last couple years happened, and boom, they stopped. This was actually technically the March 2020 crash was technically a recession. It was just a very, very short-term one because this time around, they started that money printer like nobody's business. So as they raise rates, boom, a recession follows. Every single time. I don't think there's one time that a recession has not followed. If you look at the peak, so raise rates, recession here. Raise rates, recession. They raise rates here, recession. Back here in the Paul Volcker time, raise rates, 2 recessions actually during that period from the early 80s to 1982 to 1983. So if that's not clear evidence, and why doesn't Powell show this chart? Hey guys, when we raise rates, usually causes a recession. Actually, it's got 100% accuracy. You don't see Powell showing these charts, so I want to show it on this YouTube channel. If you find some value out of them, I really appreciate if you take that 1 second to hit the like button. And if you want to be a subscriber on the channel and help my channel grow, really means a lot if you click that red subscribe down there and the bell afterwards, but only if these videos provide you information that you find to be valuable. When I first started studying the actual federal funds rate and backed up that chart to the early 70s, it was pretty eye-opening to realize, hey, they raise rates, makes it harder to get real estate, raises the rates, messes up everything for all that free money that's been going around, and you see a recession to follow. But what's interesting this time around is the Fed has done so much QE that it is unbelievable. So this is basically the money printer go burr. When you hear all the people joking around, money printer go burr, Powell's printing a bunch of money, this is the chart they are referring to. In 2008, we see the first time where they actually tried to get us out of that recession, so they print a bunch of money. And that's, at the time, it was seen like it was a lot. They printed $2 trillion. They went from, or they printed a little bit over $1 trillion because they went from 900 billion to 2.25 trillion. Stays relatively flat for a little while, and they keep money printing, and they started to ease. They started to tighten a little bit. And then boom, March of 2020 happened, and they just printed like nobody's business. And now they're sitting at $9 trillion on their balance sheet. $9 trillion in assets on the Fed balance sheet. And they're talking about stopping the printing. So not only are they going to be raising rates, but they're stopping the QE. What I think will happen is they keep raising rates. They're probably going to do another 50 basis point hike, and then they cause chaos. Markets crash, things like that happen. The recession starts unfolding, and then they have to start the QE again, and they print to oblivion, and that will not stop inflation. The only real way out is to keep hiding that inflation isn't as bad as it really is. Now it's getting pretty obvious at this point. We've been talking about it on this channel since back when it was 2-3% back in the early 2021. And now it's coming to light. And now they're saying it's 7.9%, but we all know it's quite a bit more than that if you use the real CPI figures and not their ones that they kind of eschew the data on. So really, I think inflation is back where it was when Paul Volcker was around, and it's actually, I think it's higher personally. If you use the same basket, the same CPI basket, you would see that it's up just as high as it was back then. And keep in mind, Paul Volcker had to raise the rates to over 20% to stop this inflation right here. And you're seeing the consumer price index at the time was around 13 to 14%. And to get that to stop, again, 22% to stop that. Right now, we're up at 7.9, and that's if you trust their hand-picked basket of CPI. Again, if you use this one, you would see something completely different, the same CPI that they used back then. So what are they going to do? Are they going to basically keep raising? Are they going to do the exact same thing that they did in 2008 that basically caused the housing crash? They did that. They raised rates from, and ironically enough, they were at 1%. Raising it from 1% to over 5% is what caused the recession. And now it's funny because each time it gets lower and lower and lower, and the inflation is just getting worse and worse and worse. So you see these humps getting smaller and smaller. And so it just basically tells me it's going to take a lot less to trigger a recession this time around because things are a lot worse. And so if we're already at 0 and they raised it basically just to show you guys the actual information. So if you see my cursor in the bottom right of your screen, they raised it to from here at 0 to right there. That's what they did. They raised it right there to there. And everybody's talking, oh, I can't believe Powell raised it 25 basis points. They raised it 0.25%. And they're talking about raising it to about there and bringing it up to like 1.9% and get it to right there. And keep in mind, like they had it over 2%. And so they're trying to bring it to right here. They're only about right here. And they're talking about doing a 50 basis point hike, which is again, only 0.5%. So they're going to get it to around like right there. It's playing with fire, and you really, it's embarrassing because they're not doing anything anyways. I heard Peter Schiff talking about how it's basically a squirt gun to fight an apartment fire, and I couldn't agree more. It's embarrassing that it's actually like news that people are talking about. Oh my gosh, a 50-point basis hike. What I think is going to happen, they raise it, they cause a major recession, markets panic, housing bubble. Like, it's not the same kind of housing bubble that we saw in 2008, but I do think that houses are way overvalued. Real estate is way overvalued right now, and it has a lot of room to correct. And if you make those loans harder and harder to get, odds are people aren't going to be buying houses as much as they have been. Things change when you raise that rate. So when they keep raising that rate, they could trigger this recession, which I think will obviously happen. Again, in my personal opinion, not financial advice, but it's very clear here. And at the same time, they're going to have to unwind the assets. So again, I think they're going to cause a recession. They're going to go back. So we're going to go back to the assets on hand, and they're saying that they're going to unwind this. You see this right here, this period, this is unwinding. This is getting rid of the assets on the balance sheet and selling them back into the market. They're saying they're going to do something similar, but so far they've just done a ridiculous amount of buying. This is all crazy amount of QE. From 2019, they had just under 4 trillion to 9 trillion, more than double since 2019. So in 3 years, more than doubled the amount of assets on their balance sheet. What I think happens, they cause recession, they cause chaos, and then they start the printing press back up and only pour gasoline on the inflation fire because they really can't stop it. I have some friends that think that inflation could be a transitory thing and it starts to pull back after it gets only so high. I happen to think that there's no stopping it, and there really isn't any option. So what are you going to do? Are you going to go to a 30-year treasury bond and get 2.5% to lock up your money for 30 years? I highly doubt it. I mean, just to put it into perspective here, gold is up at 1942. The gain over the last year on gold is up around like 13% right now, 13%. So do you want to lock up your money and not have custody of your money for 30 years to get a locked in 2.5% to not even stop inflation? If inflation is what I think it is, well over 15%, you're just basically locking up your money to lose purchasing power. That's what's going to happen. So any of these is outright foolish, in my opinion. Who is going to be buying bonds right now? The only people that are buying bonds are institutions that are forced to. So it's looking very dire right now based on what I'm seeing in regards to inflation. And in my personal opinion, I have some friends that will think otherwise, but in my opinion, I think you can't stop inflation. I think it's out of control and it's just going to keep going up. Unless Powell actually goes forward with these rate hikes and starts raising multiple percentages and not just like 50 basis points, I'm talking hundreds of basis points, jumping it up to 5-10%. And that's going to cause a recession and be very painful, but it's the medicine that's needed to stop inflation, which is why they're stuck in such a hard place right now. But the last thing I wanted to show in this video is the shadow stats chart here. I've shown this in the past, but I think it's very relevant for this video to show you. Let me move this over here. So this is the shadow stats figure on if you use the CPI that they used in the early 80s, it would show that inflation is higher than it was even back then. So the highest inflation was back in the Paul Volcker time where it went to over 13%, and it was almost at 15% at one point is what this chart is showing. So if you use the alternate, the blue line is the alternate CPI, the 1980s base. So that's basically saying if you use the same consumer price index basket that they actually measured back then and you didn't let them change it to make it show a lower number, it would show that right now it wouldn't be this red line that we're being told. It would actually be this line here, which is well over 15%, and inflation is actually higher than it was when Paul Volcker had to raise the rates to 22% to stop it. Pretty scary when you see the real information. So that is the video. That is all that I wanted to go over here. I just wanted to kind of rant a little bit and show the facts on why I think it's inevitable. I mean, if you study what happens every single time they raise rates, it causes a recession. And right now, everything seems very primed to do that again. So if you agree with me, let me know. If you don't agree with me, also let me know. Put a comment down below. and make your voice heard. Always really appreciate going through the comments, and other people appreciate hearing your comments as well. If you like the video, please do take that split second to hit the like button, and mainly if it gave you value. If you found this information valuable, please do hit the like button. I say it every video. It's super annoying, but it does really help with the YouTube algorithm, and I'm trying really hard to grow my channel. I'm trying to get 100,000 subscribers by 2022. So before 2023, hopefully before the recession, I can get this account to 100,000 subscribers. I keep putting that out there in the universe, and I'm doing my best to put the work in to make it happen. And with your help, I think we can make this happen. So please do click that red subscribe down below and the bell afterwards to be notified of all future videos. If you want an extra notification, follow me on Instagram at Rob Soltan on Instagram. I give a little notification whenever I make a video in my story over there, so you'll see it in the little circle story whenever I drop a video or whenever we go live. So that way you get an extra notification and you can see all of the collectibles and the things that I buy with my day-to-day business. If you follow me on Instagram, again, at Rob Soltan on Instagram, please do follow me there. Thank you so much for watching, and I will see you at the next video.